What's going on, y'all? Hope all is well. Another episode of Combos with your CFP Mario Payne in beautiful Jacksonville, Florida. Was beautiful, not the stock market today. The market was down. I'm gonna go with the Fed talking about cutting those rates so my baby TMF can grow, and also talk about some stocks that might be going down that you might want to look to sell before it goes down, baby. Like always, before we get started, like, share, subscribe to our channel as we continue to grow. Let's see what they got to say about the market today, though.
Well, investors are eagerly awaiting the latest read on inflation and what it will mean for the timing of rate cuts. CPI for the month of February is out Tuesday. The headline number year over year expected to remain unchanged from January, but core CPI.
Now, you guys remember, literally a year ago, inflation was at 9.2%. And right now it's at 3.7, estimated 3.7. It did come in at 3.9 in January. So this lets you know that inflation is getting better. And as inflation goes down, those feds, they might cut those rates.
Including volatile food and energy prices, is expected to soften a bit to 3.7%, slight decline from January's 3.9% reading. Here with more, we've got Citi economist Veronica Clark. Veronica, great to see you here this morning. All right, so the expectations are laid out. What, though, will this mean for the pathway for the Fed here, and what data dependency and the trend that they're looking for in that data is actually signaling?
Yeah. The most important thing that we're watching at 8:30 tomorrow morning is the month-on-month change in core CPI. So the year.
So month-on-month change means from one month to another, right? If it's going to be a change, it was 3.8% in December, and it went up to 3.9%. So when that happened, a lot of people that expected the Federal Reserve to lower rates in the first or second quarter this year, that kind of went away. That's why we saw a lot of the interest rate sensitive stocks like Enphase, the solar company, or Tesla, they went down. That's why we saw long-term bonds go down as well, because the thought process was might take a little bit longer. So then companies like Zoom, DocuSign, Carvana, they didn't really boost up either. But if month over month is estimated at 3.7% and it becomes 3.7%, then that means it gives the Federal Reserve headway or room to lower rates. And when they lower rates, it's like 2021 all over again. Up until November, because after that, we know the market did go down.
Year rate should be falling, but we're actually expecting to see still some residual strength in that monthly number. We're expecting a 0.33% month-on-month increase in core CPI. Now that's following a very strong January. I don't think we'll see quite a repeat of what we saw in January, but still some stickiness to services inflation in particular.
So when they say stickiness, that means that it's not going to go down as much as we would hope, right? So that 0.33 means that, some people were actually thinking this time last year that inflation would be down to 3.5, 3.6%. But again, that estimation of 3.7 means that inflation is still around. It's not down to that 2% that most people want it to go. It might take another year for that to happen, to be honest. But it just shows that inflation, even though things are getting better, is not to where we want it yet. And that's why the Federal Reserve has not raised rates. Has not lowered rates yet.
And that's not a great place for the Fed, but we kind of have seen Fed officials talking about maybe this is just some bumpiness on the path to 2% inflation, and they do still seem to want to be cutting rates as we're getting to the middle of the year. So I don't know if this February number will quite clearly change that quite enough. They still seem like they're going to be cutting.
Which is amazing, and we'll stop it there. So if we do cut rates, we're going to see stocks fly, especially interest sensitive stocks. And we're going to go over a couple of those right now. Well, first off, my profiteers, let's look at TMF. Now, again, this is long-term treasury bonds, but a more aggressive way, because when the Fed lowers rates, long-term treasury bonds go up in value. So if we're aggressive in long-term treasury bonds, when the Fed lowers rates, this is going to go up. We know with the market, some stocks go up, some stocks go down. But we know when it comes to long-term treasury bonds, when the Fed cuts rates, long-term treasury bonds go up. That's why they went down by so much. And as we can see here, if we kind of zoom out, right, it went down dramatically, right? We look here, since 2022, the last time that the Fed funds rate was at 2.5%, it was at $151 a share. And as we can see, day by day, it rolled over and went down and went down. And currently, today, it is at $57.24 a share. So our prediction is that the Fed are going to raise rates mid to late part this year. A couple barriers it has to get to. Now, we don't think it's going to get back to $151 a share. I believe that's going to happen by 2026. Pretty good gain though, right? I mean, you talk about from $57 to $150 in 3 years. I'll take that. But we can see today that the growth that will happen to get back to where it was back late 2023, 19%. Now that is basically that was right after information came out that January was not going to be too good. It came hot, right? So you can see as it went down, individuals, okay, the Fed's going to basically not raise rates. On the flip side, back in October of 23, when the Fed came out and said that they were going to raise rates in the year 2024, we saw that it grew from bottom to top, up by almost 75%. And that was just the thought process that they was going to lower rates. So just imagine once they lower rates, this is going to go up. I expect a 74% gain when this happens. And again, that 74% gain by the end of the year takes this from $57 a share to $100 a share. So $100 a share stock by the end of 2024, I would think this ETF, especially if the Fed cuts rates 3 to 4 times, that most people are predicting. We're going to go with one more stock. This next stock is Enphase. We all know Enphase Energy, right? They do solar power. I have solar power here at the house through Enphase. That's the app that we use. Same situation, right? When rates started going up, this thing started going down. As we can see from top to bottom in 2022, as it went down almost 80%. Oof, not good. I wish my solar bill went down by 80%. That's another conversation though. Now, what happens is that this is tied to interest rates because they borrow from the federal government. So when interest rates are higher, then their profit margin is lower. They can't borrow as much. But as the Fed lowers interest rates, they're going to be able to borrow more money at a lower price, which means they're going to have a higher profit margin. So again, Enphase, with the thought process that the Fed was going to raise rates, looks what happened to the stock. From bottom to top, it went up by almost 86%. But then the thought process was, okay, because of what happened in January, the Fed might not lower rates. So then my profiteers, looks what happens. It goes down. And it went down by basically 34%, right? Great buying opportunity at that time, late January, right? So since then, it's gapped up. Look at that gap. Ooh, we love this, right? We love this on the upswing. That's a huge gap right there. Anytime we have a gap like this, that is a bull signal. So it's up by 34%. When the Fed lowers rates, this is going to, in my opinion, continue to go up. I think it has to fill this gap. You see this gap right here, right? So anytime down or up, we have to fill the gap. So this filling the gap to where it was back 2023, we're looking at least 30%. If the Fed lowers rates 3 to 4 times this year, we're probably going to fill the gap up to $219 a share. Now, that is a 71% gain for where we are now. We're at $128 a share now. That's $219 a share. So if the Fed, in my opinion, lowers rates, this is going to go up because it has 2 gaps to fill. One at the $160 share range, and then this huge gap on the way down from 184 to 218. When that happens, we're all going to be happy. That's a 71% gain. I believe by the end of this year, early next year, this will happen. So we look at end phase to be going up by about 71%, theoretically speaking. World Profiteers, that was a great exercise on looking at the charts, using information. So the stock market has thousands of stocks, but if you key in on a few stocks, it is going to make you some money. Those profits might be painful when they go down, when they go up, they're happy. So comment below. What do you think about end phase? Is it going to go up? Is it going to fill the two gaps? Will it hit over $200 a share by the end of the year? What about TMF? You think that that's going to go up? You think as interest rates go down, it will go up like it historically has? Comment below. Let me know what y'all think. As always, like, share, subscribe, share the video. I hope you like the content. Hit me up on Instagram at Payneful Profits. Follow our YouTube channel. As always, let's make some painful profits together, y'all. Peace.
Making no money mistakes, make a payment on your bills and you still late, yeah. Painful profits to help you seek change, and you just wanna get paid, yeah. Tired of making no money mistakes, make a payment on your bills and you still late, painful profits to help you seek change, yeah. Cut the show and just listen. You wanna feel empowered by making money decisions. Residual by the hours can get you a better living. Been check to check, you know, and it could be different, you know.